Show must go on, as they say.
That's right. No choice special.
Yeah, we are at the top of the hour here, so we'll get started. Welcome everybody. Today, happy to present Inside the Corporation Tax Realities and Investing with Corporations in partnership with Sun Life. Our presenter today is Dan Price. Dan grew up in Southern Alberta, graduated from University of Lethbridge with a Bachelor of Arts in Political Science. After graduating and obtaining his CPA and CA, he spent 17 years working in corporate finance in both Calgary and Kelowna, eventually joining the team at Sun Life Global Investments in November of 2022. I believe he's the head of advanced planning for Western Canada at Sun Life. Outside of work, Dan is married, has two kids, keeps him really busy, just like myself. He enjoys the Okanagan lifestyle, plays most sports. He's a past president of Kelowna Chamber of Commerce and has previously volunteered as a hockey coach and the treasurer of the Kelowna Figure Skating Club. So welcome, Dan. We're in good hands. I'm going to pass it off to you. I'm just going to mute and turn my camera off while you go through your slides. And then we'll come back at the end for a fireside chat. For the attendees, if anyone has questions, feel free to type them in anytime. Just hit the Q&A button at the bottom of your screen. Pop your questions in there as we go, and I will get to those at the end. So without further ado, Dan, pass it off to you.
All
Welcome.
right. Well, good morning, everybody. Thanks for taking time out of your busy day to talk about one of my favorite subjects, which is corporate income tax. So, first things first, I apologize for my camera not being on. We had a bit of a power outage here in Kelowna, so I had to shift offices. So, unfortunately, some of the perils of not working in your own space, unfortunately. But some might say it's better not to see my face. So, maybe that's a good thing. But anyhow, believe it or not, when I was preparing this presentation, I really struggled with the why are we here question. So in other words, why would you care about corporate tax? After all, you'll have accountants, right? So here are my top 3 reasons why I think it should matter to you. First off, after-tax returns are what drive real wealth. So good investing inside your corporation isn't about maximizing gross returns, it's about maximizing what you actually keep. So even a 1 to 2% tax drag, compounded over decades, can mean tens of thousands of dollars of unnecessary tax for you. Second, for business owners, retirement isn't just RSPs and TFSAs. It's also about corporate surplus and when to start taking it out. And finally, tax directly shapes investment strategy. So as you're going to see today, not all income is taxed the same way inside of a corporation. And that changes what good investing actually looks like. So the bottom line here is simple. Tax is the single largest controllable expense in one's financial life. And for incorporated clients, it's often the difference between a good plan and a great one. In terms of housekeeping, the session should run about 30 minutes with some time at the end for any questions you may have. So be sure to keep your questions general, as I can't give tax advice on specific situations. So those still need to go to your accountants. So if that sounds okay, let's jump into some tax, shall we? And just as a reminder, as Greg mentioned, this is brought to you in part by Sun Life Global Investments. So I want to start off with a quote from the great Albert Einstein. It says, "The hardest thing in the world to understand is the income tax. This is too difficult for a mathematician. It takes a philosopher." Now, there's a lot of truth in that, especially when it comes to corporate taxation. So if I'm being honest, I still find it tricky at times, and I've been working in the field for over 20 years. So I can only imagine how you feel when you hear terms like refundable tax, integration, or passive income rules. So we may not all become Albert Einstein level experts by the end of this session, but my goal is to walk away with a clear understanding of how corporate tax works here in Canada. So that sets the stage for our agenda for today. We're going to start off with a quick, and I mean quick, review of what corporations can actually invest in. Then we're going to move into the tax side of the story. So first off, we're going to take a look at the basics of corporate taxation so that everybody has the same foundation. From there, we'll discuss how corporations are taxed on both active business income and passive investment income. because those two types of income are treated very differently under the tax rules. So next we'll talk about one of the biggest reasons that many business owners choose to incorporate in the first place, and that's tax deferral. The ability to leave money inside a corporation at lower tax rates can create a significant pool of capital available for investment and growth. But as many of you already know, the government doesn't give us unlimited room to do that. So once a corporation starts earning too much investment income, certain tax advantages begin to disappear. And that's where planning becomes very important. So we're going to take a look at the rules surrounding passive investment income, the potential impact on your corporation, and some strategies that business owners and their advisors use to manage those challenges. So there's a lot of value material coming at you today, and fair warning, there will be some technical sections, so have a sip of coffee if you've got one going. So let's start off today by talking about what a corporation can invest in. And spoiler alert, as you'll see, the list is very similar to what an individual can invest in. So just like an individual, a corporation can invest in GICs. They can invest in insured wealth products such as payout annuities and segregated fund contracts. Corporations can also invest in mutual funds, both mutual fund trusts and mutual fund corporations, aka corporate class mutual funds, and we'll be talking about those more later on in the presentation. Corporations can also invest in things such as rental properties, stocks, bonds, ETFs, and finally, life insurance is a very popular investment inside of a corporation for estate planning purposes. So as you can see then, there's no shortage of things that corporations can invest in. So next up, let's take a step back and look how the corporate tax system works here in Canada. I'm going to be introducing some concepts that you may have heard of, but what matters is how they directly influence big decisions, such as whether or not to incorporate your business, and how to invest excess profits. And ultimately, that can have a meaningful impact on your after-tax outcomes. Let's take a look. So before we get into the details, let's review a couple of key facts regarding the taxation of corporations. So first, let's talk about something called tax integration. Now, at its core, integration works to ensure that your tax bill is roughly the same, whether business income is earned personally or inside of a corporation. But does it work perfectly? Not at all. And one of the biggest reasons for that is that the tax rates, both personal and corporate, vary by province. So depending on where your business is located, incorporation can either create a small advantage or a slight disadvantage. And that's something we'll explore later on in more detail. So here's a quick little case study on tax integration in action here in Alberta. So let's assume that your business earns $250,000 of active business income this year. First off, if you earn that income personally, you'd pay just personal tax of just under $82,000, which would leave you about $168,000 after tax. Next, if you earn that money through a corporation, there would be two rounds of tax. First, there'd be $27,500 in corporate income tax, and then just under $56,000 in personal tax on the dividend to get that money out of the corporation, which would then leave you with just over $166,000 after tax. So as you can see in the box, the total taxes paid is fairly close under both scenarios. Thus, we're almost fully integrated. Small advantage to earning that money personally in Alberta, but certainly nothing significant. So next, let's look at how corporate tax differs from personal tax. So unlike individuals who pay higher tax rates as their income increases, corporations are generally taxed at a flat rate. Now that said, not all corporate income is taxed the same way. The tax rate depends on the type of income being earned, whether that's active business income or investment income. And that's where we're going to explore next. So when it comes to taxation of income earned inside a corporation, source matters. Specifically, whether that income comes from active business operations or from an investment portfolio. So let's start with active business income. So as the name suggests, this is income coming from companies' core business activities. For example, for a dentist, it's income from providing dental services. for a hardware store. It's income coming from selling products and services. But what it doesn't include, though, is income from property, such as corporate investments. As we'll see, investment income is taxed very differently from active business income. So why is active business income important to you? Well, as you can see on the right, the general federal tax rate on corporate income is 15%. But now for the magic. Through access to something called the Small Business Deduction, or SBD for short, many small business owners qualify for a lower rate of 9% on their first $500,000 of active business income each year. So in that case, the $500,000 is your profit. So at first glance, seems like a great deal, right? 6% tax savings. But unfortunately, that's not quite the full story. So when your business qualifies for the small business deduction, yes, you do get that lower 9% tax rate inside the corporation. But when you take that money out personally as a dividend, you're going to pay a higher rate of personal tax. And that dividend is what we call an ineligible dividend, which you may have seen before on a T5 slip. Now, on the flip side, if your business doesn't qualify for the small business deduction, you're going to pay that higher 15% corporate tax rate up front. But then when you take that money out, you're going to pay a lower rate of personal tax. And that's what we call an eligible dividend. So we have a bit of a seesaw effect going on here. If you pay lower corporate tax, you're going to pay higher personal tax. If you pay higher corporate tax, you're going to pay lower personal tax. So overall, though, you should pay roughly the same amount of tax either way. So instead of permanent tax savings, that 6% gap is really just a tax deferral opportunity. And if that's new to you, trust me, you're not alone. This is one of the most commonly misunderstood aspects of corporate tax. So the answer to our question of why active business income matters to you is that it gives you access to lower tax rates up front, which means you can leave more money inside the corporation, either to invest in the market, to grow the business, or to fund future cash flow needs. But the good news doesn't end there. So in addition to that 6% deferral opportunity at the federal level, there's also a provincial component which can make this even better. So here in Alberta, the combined federal and provincial corporate tax rate is 23%, but with the small business deduction, that rate drops to a mere 11%. So we're no longer talking about a 6% deferral opportunity anymore, we're talking about 12%. Now let's put that into dollars. Let's assume you make $500,000 of active business income in your corporation. Without the small business deduction, your corporate tax would be $115,000. But with the small business deduction, that drops to $55,000. So that's a $60,000 difference that can stay in the corporation and can be put to good use. And remember, this still isn't permanent tax savings, it's tax deferral. But now we're talking about deferring tax on a much larger amount of capital, which can have a significant impact over time. So that wraps up active business income. So the key takeaway is that the small business deduction provides access to a lower corporate tax rate, creating an opportunity to defer tax. And when less tax is paid up front, there's more money available to reinvest. So whether that's back into the business or into investments. So now let's switch gears and take a look at passive income. Because when it comes to corporate tax, passive income is a whole different story. So generally, passive income comes from portfolio investments or from rentals. As I mentioned, it's taxed differently than active business income. So first off, there's 3 rounds of tax on it. There's federal tax, provincial tax, and a refundable tax, which I'll explain more on the next slide. Now, it's important to know that different types of investment income are taxed at different rates. So now let's explore these in some greater detail and see how they can affect your corporate investment strategy. So as you can see on the chart, different types of corporate investment income attract different rates of tax. So here in Alberta, interest, rental, and foreign income face the highest tax rate at almost 47%. Dividend income is a little better at roughly 38%. And capital gains receive the most favorable treatment because only 50% of the gain is actually taxable. And that results in a tax rate of about 23%. So if you're simply looking at the chart, the conclusion seems pretty obvious. Avoid interest income and focus on dividends and capital gains whenever possible. But does the chart tell the whole story? So you might be thinking to yourself, if my corporation pays about 47% tax on interest income, and then I pay personal tax when I eventually take that money out of the corporation, isn't that double taxation? That's a really fair question. So fortunately, that's where the refundable tax system comes into play. As you can see in the box, a significant portion of the tax paid on passive income isn't meant to be permanent. So for example, with interest income, the corporation initially pays tax at 46.67%, but then when profits are later distributed to shareholders as dividends, approximately 30.67% is refunded back to the corporation. So when we net those numbers together, the corporation's effective tax cost on that interest income falls to about 16%. So that's a very different result than what the headline tax rate suggests. So the question now is, how do we get those refundable taxes back? Well, to do so, the corporation has to pay a dividend out to the shareholders. And the rule is that dividend must be 2.61 times the refundable tax balance. So in our example, the corporation paid $3,067 in refundable tax on $10,000 of interest income. Multiply that by 2.61, and you need roughly $8,000 of dividends to trigger the full refund back to the corporation. So what's really happening here? Well, the corporation earned $10,000 of interest income. But to recover the refundable tax, most of that income needs to be flowed out to you as the shareholder. So in other words, you have to trigger personal tax to get a refund of corporate tax. Only in Canada, right? And that's exactly the point. CRA is comfortable with low tax rates on active business income, but when it comes to investment income, they want you to end up paying roughly the same amount of tax as if you'd earned that income personally. So that's why I like to think of refundable taxes as either a prepayment of tax or the great equalizer. But whatever you call it, it's a big thing for anyone holding investments inside of a corporation. Now, remember a few slides back when I mentioned that only 50% of a capital gain is taxable. Well, the obvious question is, what happens to the other 50%? Well, believe it or not, CRA keeps track of it in something called the capital dividend account, or CDA. So think of the CDA as a special tax account that records the non-taxable portion of capital gains earned by the corporation. And here's where it gets interesting. When there's a positive CDA balance, the corporation can elect to pay something called a capital dividend to shareholders. And unlike a regular dividend, a capital dividend is completely tax-free to you personally. You heard that right, tax-free. It's one of the most valuable benefits available to corporate investors and one of the key reasons that capital gains are often so attractive inside of a corporation. Now let's look at how the capital dividend account works in practice. So suppose your corporation realizes a $10,000 capital gain. As we discussed, only 50% is taxable, so $5,000 gets taxed. The other $5,000 isn't taxable, and that amount gets added to the corporation's capital dividend account. That CDA balance can then be paid out to the shareholders as a capital dividend, and the great news again is that it's received completely tax-free. Now, in reality, I don't see corporations paying out capital dividends this small, and that's because there are legal and accounting requirements involved, and the professional fees can easily run into the thousands of dollars for that type of transaction. So what many business owners do is accumulate their CDA balance over time and then pay a larger capital dividend later on when the tax-free payout is large enough to justify those professional fees. So the key takeaway here, though, is that every capital gain can create a valuable pool of money that can eventually be distributed out to shareholders completely tax-free. Now, capital gains aren't the only thing that can increase a corporation's capital dividend account. There are a couple other important additions as well. First, if your corporation receives a capital dividend from another corporation, that tax-free amount generally gets added to your CDA. So for example, if you have an operating company and a holding company, maybe your operating company pays a capital dividend up to the holding company. And that amount is then available to pay out of the holding company to you tax-free. Second, and often more significant for business owners, is corporately owned life insurance. So in a nutshell, when an insured person dies, a portion of the death benefit can be credited to the CDA account, thus allowing those funds to be paid out as a tax-free capital dividend to the shareholders. And because of the substantial tax-free CDA that can be created, corporately owned life insurance is a very popular estate planning tool for incorporated business owners. So we'll leave the insurance discussion for another day, but it's definitely worth exploring with your financial advisor. So before we move on, let's do a quick recap. We looked at both active business income and passive investment income, and we've seen that they're taxed very differently inside a corporation. We also learned that active business income may qualify for the small business deduction, which creates a valuable tax deferral opportunity by allowing more after-tax dollars to remain in the company. But that's not the only deferral strategy available to incorporated business owners. There's another opportunity that comes from being able to control when and how much income you take personally from the corporation. And as we'll see, that can create some powerful planning opportunities. But with every opportunity comes risk. So let's take a closer look. So to bring this concept to life, let's look at a simple case study. So let's meet our friend, Mr. ABC, and he owns 100% of the shares of ABC Limited. So the company's doing very well and earns $250,000 of active business income every year. So we also learned that Mr. ABC only needs $100,000 after tax to support his lifestyle. Now, if we step back from this and think about it for a moment, there's an obvious disconnect. The corporation is generating $250,000 annually, but Mr. ABC only needs a portion of that income personally. So that means there's a cash surplus being generated inside the corporation. And whenever we see surplus cash, the question we should be asking is there a tax deferral opportunity here? In other words, can Mr. ABC leave some of that income inside the corporation and defer personal tax until he actually needs the money? Let's find out. So let's see what happens if Mr. ABC takes all the corporate profits out every year. So after he pays both corporate and personal tax, he'd be left with just over $166,000 after tax. Sounds pretty good at first, but remember, Mr. ABC only needs $100,000 to fund his lifestyle. So the question becomes, did we take too much money out of the corporation? Because every dollar paid out beyond what he actually needs triggers personal tax today. So in other words, by withdrawing the full amount of the profits, we may have overpaid personal tax unnecessarily. So the question is there a better way to approach this? Well, of course, there's a solution. So instead of paying out all the corporate profits, we can simply reduce the amount of his dividend. So the goal is to pay Mr. ABC just enough so that he nets exactly $100,000 after tax and no more. So when I ran the numbers, it turns out that a dividend of just over $118,000 does the trick. And that leads to something really important. So rather than paying everything out, we can leave the remaining business profits inside the corporation. And why does that matter? Because the money avoids immediate personal tax, creating another valuable tax deferral opportunity. And now those dollars can continue to working for Mr. ABC inside the corporation. They can be used to pay down debt, purchase inventory or equipment, or simply be invested inside the corporation in the market. So the key idea here is this. If you don't need the money personally today, there may be an advantage to leaving it inside the corporation and deferring personal tax until a future year. Now, let's fast forward 10 years and see what's changed for the corporation. First, we can see that our tax deferral strategy has worked really well, as the company has been able to build up a sizable investment portfolio of $1.5 million. So we've taken those tax savings each year and we've invested them in the market. At the same time, the business has continued to grow. Taxable income is now increased to $500,000 per year. So $425,000 of that comes from active business income, and now we're generating $75,000 from that investment portfolio. So our question after 10 years is no longer can we defer tax, but rather should we still be deferring tax? Is this still an opportunity, or is it now a risk to the company's small business deduction advantage? So just where does the tax risk lie at this stage? Well, it comes from a change in the passive income rules that CRA introduced a few years ago. At a high level, these rules put a limit on how much passive income a corporation can earn before it starts losing access to the small business deduction. Here's how it works. If the corporation earns between $50,000 and $150,000 of passive income in a year, the small business deduction limit is gradually reduced in the following year. And that's at a rate of $5 for every $1 of passive income in that range. And once passive income reaches $150,000 in a year, the small business deduction is completely eliminated in the following year, which means that the corporation's active business income is no longer taxed at the 11% rate, but instead at the much higher 23% general rate. And finally, keep in mind these passive income thresholds you see on the screen aren't applied per company. They're applied across all associated corporations in your corporate group. So for example, if you have an operating company and a holding company, they share that $50,000 limit. So this chart just illustrates what we just talked about. The more passive income you earn, the less small business deduction you get. It's gradually eliminated after $50,000 of investment income, and your small business deduction is completely wiped out at $150,000 of income from investments. So now going back to our case study, ABC Limited is now earning $75,000 of passive income from the investment portfolio. With a threshold of $50,000 before penalty, the company is now $25,000 over the limit. And remember how the rules work. For every dollar of passive income over that threshold, the company loses $5 of its small business deduction limit in the following year. So in this case, we're $25,000 over, multiply that by 5, and we can see the company will lose $125,000 of its small business limit next year. So now let's put that into context. Company normally starts with a $500,000 small business limit. After the grind, it loses $125,000, leaving $375,000. Now, for most small business owners, this actually wouldn't be an issue because their active business income would likely fall well below the $375,000 limit. But that's not the situation here, as ABC Limited is earning $425,000 of active business income. So we're $50,000 over this new limit. So the question is, what's the tax impact of all this? Well, unfortunately, earning too much passive income causes the company to lose some of its tax deferral advantage, which means it's going to pay more in corporate taxes. So normally that $50,000 in income between $375,000 and $425,000 would be taxed at this 11% small business rate. But with the passive income grind, that income is now taxed at 23%. And this means an additional $6,000 in corporate taxes. And importantly, that cost only grows and grows and grows as passive investment income continues to increase. So now the question becomes, is there anything we can do about this problem? And this takes us into tax planning strategies for managing passive income inside a corporation. And this is where the right advice can have a big impact on your after-tax outcomes. So if preserving access to the small business deduction is important to you, we need to manage the amount of passive income being generated inside of a corporation. So one approach is to remove excess cash or investments that aren't needed for the business. So for example, you could pay yourself a dividend or bonus and then invest those funds personally. Now, the trade-off, of course, is that this triggers personal income tax. Another option is to use excess cash to pay down corporate debt. So whether that's bank debt or even shareholder loans, which can often be paid out tax-free. There's also some longer-term planning opportunities, such as something called an individual pension plan, or IPP. Without getting in the weeds too deep, an IPP allows money to move from the corporation into a registered pension structure where it can continue growing on a tax-deferred basis, much like an RSP. So for that reason, I often like to call IPPs an RSP plan for business owners. And then there's corporately owned life insurance. So again, without getting into the weeds too deep, growth inside certain life insurance policies isn't taxable to the corporation, and therefore doesn't generate passive investment income. So while the corporation is still technically investing, it might avoid creating the passive income that can erode access to our small business deduction. And finally, we can revisit what the corporation's investment strategy is. And that's where we're headed next, because not all investments create passive income in the same way. So here are a few practical strategies to consider when reviewing a corporation's investment portfolio. First, if the company is getting close to that $50,000 passive income threshold, be very careful about realizing capital gains. So to do so, you might choose to delay selling investments or sell investments over a couple different tax years, spread those gains over multiple years. Or you could sell some of the losers in the portfolio, generate some capital losses to help offset those capital gains in the same year. And second, consider what you're investing in. Not all investments generate income the same way. Some growth-oriented investments pay little to no dividends or interest. Thus, you're able to defer taxable income until the investment is eventually sold. So think of a company like Amazon, for example. And finally, you may want to consider using things called corporate class mutual funds. So these investments can be structured to improve tax efficiency and potentially reduce current taxable income inside the corporation. And that's exactly where we're headed next. So you may or may not know there's actually two different ways a corporation can invest in a mutual fund. The first is through a mutual fund trust, where the corporation purchases units of the fund. And the second is through a mutual fund corporation, often referred to as a corporate class mutual fund, where the corporation purchases shares instead. Now, from an investment perspective, the two can look very similar. You still get professional management, exposure to the markets, but from a tax perspective, there are some important differences between the two structures. So let's take a closer look and see how a corporate class structure can create some valuable planning opportunities. So with a mutual fund trust, which you typically would invest in, distributions to your corporation can be in the form of interest, foreign income, dividends, and capital gains. Now the problem is, we saw that interest and foreign income are taxed quite heavily inside of a corporation, making them less tax efficient. A corporate class mutual fund, though, works differently. Any distributions are going to be generally paid as Canadian dividends or capital gains, which, as we saw, are taxed at lower rates. And importantly, we avoid those heavily taxed interest and foreign income distributions. So be sure to talk to your financial advisor to see if corporate class mutual funds can benefit you. All right, well, that brings us to the end of the presentation today. Boy, we covered a lot of ground in a short amount of time, didn't we? We started out with the basics of corporate taxation and saw how corporations can create valuable tax deferral opportunities, particularly through that small business deduction. We also discussed the downside of success, that retaining too much capital in the corporation can generate passive income and potentially reduce access to that small business deduction and that low rate of tax. So fortunately, there are strategies available to help manage that risk. And one of the tools that we explored today was the use of corporate class mutual funds. Ultimately, at the end of the day, there's no one-size solution that fits all. The right strategy depends on your goals, cash needs, and overall tax situation. So I want to thank you for your time and attention today. And now I'll turn things back to our host to see if there's any final questions, or we can begin that roundtable discussion. Thank you so much.
Awesome. Thank you so much, Dan. That was a great presentation. Um, lots of fun stuff in there for sure. Reminder to our attendees, you can type your questions in by hitting the Q&A button at the bottom of your screen, and I'll get to those. And as well as a reminder, there will be a recording available later. So if you have a friend or you know somebody that should take a look at this, just let us know and we can send you the replay link so they can view the presentation as well. First question, Dan, and yeah, feel free to take this in any direction that you like. What's the difference between the dividend tax credit and the capital dividend account?
Yeah, two very different things there. So as I mentioned in the presentation, a capital dividend is one that can actually be paid out tax-free to the shareholder. So it's about the best deal you can get for getting money out of a corporation. So it's one that tends to get forgotten quite a bit. So for example, I had an advisor one time call me, and a client had sold a rental property and had a $200,000 capital gain. So of course their client was upset, you're going to have to pay tax to get that money out. But, we quickly reminded them that, half of that gain, so $100,000 could actually come out tax free. So big surprise to the client, and definitely changed that dynamic of that conversation, let me tell you. So the dividend tax credit, what that is it's a mechanism that applies on the personal tax side. And what it does is it reduces the overall tax rate on the dividend income that you're declaring on your tax return. So for example, if you earned $100 in salary, you'd be taxed at a much higher rate than you would if you earned $100 as a dividend. So $100 each way, just different taxations because of this mechanism here. So what the dividend tax credit does is it tries to prevent double taxation when you're taking money out of your corporation, in a nutshell.
Awesome, thank you. Next question, Dan. You mentioned the seesaw. I imagine it as levers,
Yeah.
but it seems like there's a lot of there's a lot of gamification to this. It seems like a lot of ability to tinker. What are some questions that people should be asking their accountants to make sure that they're managing this correctly, or that the accountant is on top of it year by year?
Yeah, I think most people, like most small businesses, are going to get access to that small business deduction. So that nice, really low rate of tax, which is, really an incentive for people to go out there, take a chance, and frankly, start up a business. So it's a great thing. As we saw, it allows you to defer tax. So that's going to be the default. So if your business is paying significantly more than that, they're either generating $500,000 plus in income. So a portion of that would get, taxed at the 23% and the rest at, say, 9%. But, it's something that the accountants are going to have a handle on. The tax system, the software, defaults to that anyway. So, pretty unusual if they miss that. I think the bigger question for business owners in terms of managing things is, how do you pay yourself? You do need to take money out of the corporation. So there's a few different ways you can do that. You can take a salary from the corporation, which is very simple. You get a T4 just like you or I would get, for instance. They could just exclusively pay themselves dividends as well. That's another option. And a lot of business owners do that as well, just to keep their taxes low. So with that dividend tax credit that you just mentioned, Greg, you can pay a lower rate of tax on dividends. So you take a dividend instead of salary, you're going to pay less personal tax. But I think the best scenario for most people is have a mix between the two. I think that seems to be the typical scenario. So if you need $100,000 in income, maybe you take $80,000 in salary, max out your CPP each year, and then you just top that up with a $20,000 dividend, which gets taxed at a lower rate. So the sky's the limit. That's the beauty of having a corporation, is you can play with those numbers and create any result that you want. But what I always tell people is to work backwards on this. Tell like someone like yourself, Greg, I need $8,000 a month after tax, and then we can work behind the scenes and come up with a number of different scenarios to get that. So the skies are the limit when it comes to scenarios to get that exact same result. So again, that's the beauty of a corporation, is you can pay yourself any way you want.
For sure, yes, a lot of considerations and in some cases the ability to make some changes year by year. You mentioned life insurance briefly, Dan. For somebody who's maybe just coming upon some success with their business and seeing retained earnings. Should what questions should they ask themselves in terms of should they approach the corporately owned life insurance first, or should they build up the investment account, to the point of achieving that 50,000 of passive income first?
Yeah, I think this is one of the biggest areas where I see business owners make mistakes. You know, they've worked at their business for 20 years. It's starting to become successful now. You know, you're in your 50s or 60s. But what business owners tend to forget about is, you know, those shares that they're holding in their business are going to be taxable to them at some point down the road. So where they're making mistakes is they're not talking to their accountants about what we call postmortem tax planning. So planning for your eventual death and funding that tax bill, right? So if all your wealth's tied up in the shares of those business and you don't hold a lot of investments outside, not a lot of liquid cash, you know, how do you pay your final tax bill? CRA is going to come knocking at some point in time. So often that's where life insurance comes into to play there, because when you pass away, either your corporation or even your estate is going to receive a check. So now you at least have some liquidity outside of your business to be able to pay that tax bill. Because CRA will get their money somehow, as we know. So it's better that we, plan for that. So always know, talk to your accountants. What does your terminal tax bill look like? And then talk to someone like yourself, Greg, and make sure there's a plan in place to fund that tax bill.
For sure. On the same kind of note, let's say the business owner has built up significant assets within the corporation, and there's not a family succession plan or anything like that. It's going to be a sale and a divestment while the business owner is alive. How far out should they start chatting with their accountant about the sale, and things like cleansing the corporation of passive investments and some of those topics?
Yeah, for sure. I would generally say 3 to 5 years out if you're contemplating a sale. So, like what you just alluded to was, if someone's buying your business, they don't want to buy your cash and investments, right? They just want to buy your equipment, they want to buy your inventory, they want to buy your goodwill. So, a lot of times, what we'll do is we'll work with the accountants and come up with a plan to get those assets out of the corporation. So, either move them up to a different company that you own, say a holding company, and you just sell the operating company, or perhaps again you pay yourself a dividend or bonus, get that money into your personal hands, and then invest it outside of your corporation. So a couple of different ways we can go. The main point is, if you are contemplating a sale of your business, talk to your accountant, get a plan in place, and just make sure you're not missing access to, say, like the capital gains exemption, which is super valuable. Basically shelters $1 million of capital gains if you get it. So you would be very sad if you didn't get it just because of something you didn't plan for.
For sure. On the life insurance topic, are there any special considerations for corporately owned life insurance in terms of borrowing against an overfunded cash value policy?
Yeah, I won't get into the weeds too deep here, other than to say it's a complicated transaction, and you got to cross the T's and dot the lowercase J's on these to make sure that it flies with CRA. Because at the end of the day, you're personally borrowing money from your corporation, so there has to be an agreement in place where you're compensating your corporation for the use of that money. So it's a popular strategy out there. Not to say it doesn't work, but you do have to be careful to make sure that you're considering everything and not getting yourself into some tax trouble doing it. So always speak to your accountant and your advisor first before you start, borrowing money from your corporation or one of your corporation's life insurance policies.
Awesome. Thank you so much, Dan. That's all we have for questions. So again, appreciate your time. I'll let you get back to your day. And again, to the attendees, thanks for coming. And if you'd like a replay, or you'd like to dive into any of these topics further with myself, Brody, or Dan, let us know. And thanks for your time, and thank you, everyone.
Thanks, everybody. Have a great one.
Take care. Bye for now.